Hello, everyone, and welcome to this webinar. So today we're going to be talking about Sphere NIO. Sphere NIO is a multi-asset investment fund, and it's mainly curated for the non-resident investor, right? So without more ado, let's get started. So what happened in the first half of 2023? Like, what are our takeaways from this year? So when we started the year, right, say like around Jan, Feb, and even around the start of the financial year, most investors, including us, right, we were all expecting sustained volatility in the markets this year, right? And this was the case for a bit earlier in the calendar, like from Jan to April, right? But post April, the move has been one way, right? And we also hit a new market peak, incidentally, where the Nifty reached 20,000 in intraday trading as well. So, in this scenario, if you want to categorize the winners, right? If you want to look at investors who won in this market scenario, they were investors who conserved cash and waited, right, for the market to drop. Sorry, they were not those people who conserved cash and waited for the market to drop, but those people who were continuous and systematic in their investing, right? So this can give you the idea. If you have the right idea, right, you don't need to worry about the overall market context for you to invest, right? You can be systematic and consistent in the right idea, and you can win, right? And so also 2023 has been a really interesting year for us in the sense that we had opportunities to both invest and exit some investments, right? So some ideas have played out really well and were either reducing our position in that space, or we have fully exited, right? And there are ideas where we've started building positions just a bit by bit, right? We've just built our starting position and then we're slowly building to our target, right? And there are other ideas in the pipeline for the second half of the year, like ideas which we have identified, but we haven't started investing in. Be that for, it can be due to multiple of reasons, right? So needless to say, this year is proving to be very eventful, which most of us were not expecting in the beginning. So what can you do as an investor, right? So to be a successful investor, one must participate in opportunities, right? So recycling capital, which is, selling idea X and buying idea Y, and then selling idea Y and then buying idea C, right? That can only take you so far, right? So adding fresh capital to your portfolio will enable you to participate in more investment ideas and increases the size of your portfolio, right? Increases the capital. So when your portfolio is adequately sized, compounding can do wonders to your portfolio, right? So adding more capital helps you increase the size of your portfolio and gives you higher compounding. So here are a few saving choices we noticed that NRIs make, right? We've come across a lot of investors who prefer to invest in real estate, right? And another popular choice is NRI deposits where the interest is tax-free. And there are also investors who choose insurance policies such as money-back policies and endowment policies. And there are also a lot of local bank deposits in the Middle East. That is another common option that we've come across. So here are a few problems that we've noticed NRI investors come across when investing in real estate. Right. So firstly, finding tenants and keeping an eye on the tenants becomes difficult. And there's a lot of scope for tenants to take advantage and not pay rent on time, misuse and ill-treat the property, right? And eventually finding good tenants becomes difficult and it becomes a challenge. And even when you keep the house idle, right, you'll still have to pay maintenance charges, and eventually repairs might also need to be made for when the house is kept idle for too long, right? And an asset which is supposed to make you money, create income for you, might as well end up costing you more just to maintain it. Right? And naturally, income is income, and there are going to be tax implications. So, selling real estate properties might also end up becoming a problem, right? But as buildings get older and newer buildings around the area come up, right, the demand for the older building goes down and the building starts losing value. So at this point, finding the right buyers becomes difficult, and it ends up being a long and drawn out process. And you might not make what you expected uh, out of the investment, right? Might have had an idea of a return number going in, and you might not end up making that at the end, right? If it doesn't go to plan, if everything messes up. Right? So this is um, like something we've noticed that investors, I wouldn't say fail to consider, but don't give as much importance to as they should. Right. So when it comes to NRE FDs, right? The NRE FD is a really good investment, but it's a good investment for some people. So when it comes to NRE FDs, the investment horizon is set by the banks, right? So if you're investing with a set goal and your goal duration does not match that, right? Then your invest and so if your goal duration does not match the duration of the deposit, it would be a little inflexible, right? But again, that being said, if it does match the deposit's tenure, it's a great option, and the returns are fairly attractive, and the investment is tax free as well, right? But when it comes to insurance, right, that is something that we must pay closer attention to. So, in this year's budget, the tax benefits for endowment policies and money back policies have been reversed for premiums exceeding 5 lakh rupees, right? And similarly, for ULIPs, the maturity proceeds may be taxed in the long term. So, these options would neither provide sufficient returns nor do they provide adequate cover, right? And the returns for these products would be similar to a bank FD, or in some cases would be below that as well, right? And with ULIPs, right, the added cost of the cost of management and various other costs, right? So all these costs would eat into the returns, right? And yeah, and they would eat into the underlying funds returns, so instead of a ULIP, one might look at buying a term insurance plan for insurance cover, and then a good mutual fund scheme or a basket of good mutual fund schemes for market exposure, right? And this option would end up cheaper and give you better returns in the long run as well. So most banking products that we see are debt-oriented products, right? They invest more towards fixed income than towards equity. So you might even see a sort of 75-25 split in favor of debt. And when you're picking a long-term investment product as an investor who wants to save for the long term when you're, say, in your 30s or your 40s, right? This type of investment product becomes unattractive for you. So equity exposure in your portfolio, when it becomes limited, it limits your portfolio's ability to compound to that extent, right? Like a pure equity product. So this is fairly simple enough. The Middle East has no taxes on neither income or capital gains, right? So NRI investors would only have to pay Indian tax rates on Indian investments, right? And regardless of whether you have income in India or not and are paying tax or not, right? it's important to maintain a record in case something comes up in the future, right? So what we always say is that it's the best practice to always file income taxes every year, even if you don't have any taxes as such. Okay, so moving on to currency risks. So we all want to predict currency movements, right? And it's a very tricky thing to do and to do accurately, right? Even for experts, because there are just too many factors involved. So the only option is to prepare yourself, right? And you can do this by minimizing layers in your portfolio. So you can try to be more direct, right, while making foreign investments. So, for example, some funds of funds may route investments through multiple countries and multiple currencies, right? And this adds layers of currency risk to your investment portfolio. And the next thing is to look at macros. So, monitor historic rates of currency appreciation or depreciation, right? Currency strength is also dependent on underlying economic activity such as imports and exports, debt servicing, and growth, right? So that needs to be studied as well. And another effective way to align your and another effective way to um, moderate currency risk is to align your currency with gold, right? Say you want to send your child abroad to the US to study in 15 years, right? You should definitely have some investments in the US. Long, you should definitely have some investments in the US starting long before that, right? So that your money can grow with the US economy in the American currency, right? Or if you want to retire in India, or you feel like you need some emerging market exposure, then you need to make investments in India. So here's a study that we did, and every investor should look at the returns that they made in real terms, right? So this means that your investment performance must be measured, keeping inflation and currency depreciation or appreciation in mind. So these two charts show the average inflation over the last 6 years for the UAE, Bahrain, Saudi Arabia, as well as the average 6-year appreciation against the rupee. And this is for the riyal, for the dinar, and the dirham. So when you invest outside your country, you must account for currency depreciation as well. And when judging returns, you need to look at if the returns may beat the long-term average risk-free rate plus currency depreciation, right? And your average inflation is relatively low in the Middle East. The highest is at around 1.4%. So most assets that you would invest in would beat the inflation rate in the long run. Even if you have a couple of bad years, in the long run, it would beat a 1.4% inflation. Okay, so this chart assumes that we've put 100 rupees in these three indices 5 years ago. The MSCI World Index, the Nifty 50, which we've taken as a proxy for India, and the GCC Index, right, which is the Gulf Index. So the GCC outperformed the World Index with a CAGR of 7.5%, right? And the Indian index was able to return around 11.5% this time, right? So why is there this disparity between the world and an emerging nation? So from 2015 to now, India's moved to number 5 in terms of GDP, right? And we're only growing faster. So we're already a $3 trillion economy. So the first trillion took the first 67 years. To reach the second trillion from the first trillion took 8 years. And to reach from the second trillion to the third trillion took only 5 years, right? And pre and post pandemic, we were the fastest growing, largest, large economy in the world, right? And in terms of flows, um, over the last 3 years, we've received the highest level of FDI flows. Um, and we also received the highest level of FDI flows during the pandemic, right? And this FDI inflow was inclusive, right? In the sense that it wasn't only to the metro cities, right? It was way more broad based than like how it was before. And the one currency that's been strongest in terms of EM currencies, one of the strongest EM currencies has been the rupee, right? And the flows that we've received are a great indicator of the fact that India is one of the biggest opportunities people see in creating wealth. So let's see if it's actually easy to create wealth, right? This chart shows how assets have performed over the last 12 years, right? So it shows us that no asset has stayed in the top three for more than 3 years at a stretch, right? So, say if you look at small caps, right? You saw that small caps were the best performers in 2017, and this is one of the most talked about, like phases in the market, right? 2018 and 2019, small caps were the bottom performers, right? If you look at gold, for example, in 2018, it performed reasonably well in 2018, 2019, and 2020, 2021. It was the bottom, and 2022 were back up again, right, with gold. So, and then if you look at large caps, right, through 2017, 18, 19, it was third in terms of performance. And then after that, it's dropped to fifth again, right? So this gives you an idea that the markets are cyclical, right? So you can't go and invest based on what people have been doing in the past, right? That might only lead to failure. You need to be more forward thinking, right, than the broader market if you want to outperform it. So in our conversation, what we've noticed is that NRIs really want a product that is stress-free, something that can create sustainable wealth, and something that's scalable, something that helps you achieve your retirement corpus and grows with the country, right? And you want to do all of this while you minimize risk. So how does Sphere NIO help you with this? So this is a product curated specifically for your needs. We take care of buying the right asset class at the right time and create the liquidity for the product, right? So this product is versatile enough and can take advantage of the right asset class, right? And this makes it sustainable for consistent contribution and constant scale, and invest in winners of the future. So Sphere NIO comes from 12 years of development under our RIA practice, right? And the learnings and the constant improvements to the RIA have been fundamental in the creation for Sphere and Sphere NIO, right? And this multi-asset concept and performance, this structure is validated not through back testing or something theoretical, but by real world results through multiple market cycles, right? Where we've constantly participated. And Sphere is extremely versatile in the fact that, in the sense that we can, dynamically allocate two asset classes. One second. Yeah, sorry. I thought something came up. Sorry about that. Yeah, SPHERENIO is extremely versatile in that we can dynamically allocate to the asset classes with no upper or lower limit, right? Meaning that there are no bottlenecks. And we can act with full conviction whenever opportunities present themselves, right? And whether they be in different sectors or different asset classes. And in a PMS model, with Sphere NIO and Sphere. In the PMS model, moving between asset classes is much smoother, right? And the process is more streamlined. So whether we want to move from an ETF to direct equity, right? This sort of process is a lot smoother in a PMS model. So let's take a look at an example of when we played a cycle. Right. So pharma was one of the most loved sectors in 2020 due to COVID and the need for a vaccine. And people ended up and people started paying higher and higher multiples for these businesses, right? And the sector ended up outperforming the broader market by about 2.5% on a CAGR basis, which is quite significant, right? But there was a long period where it tested our patience before this bull run, right? So in early 2018, we cited that there was a need to build around defensives, right? There was a need to build the portfolio around defensives, right? As small caps were trading at unsustainable valuations, like we saw in the other chart, right? So 2015 was the last boom in the pharma space, and the pack was about 40% down from peak. And by the pack, I meant the benchmark, right? The Nifty Pharma Index. Um, so, anyways, we started buying that back in 2018, right? And pharma's focus at that point had shifted primarily from export to more domestic and specialty formulation businesses, right? So our investment strategy was always to take things slow and build on our conviction constantly, right? So with every 4 to 5%, we bought with right. So we bought around 4 or 5 tranches of 4 to 5%, and we built the pharma position to about 20 to 25%, right? And so yeah. Yeah. So we had built by this point the pharma position to 20-25%. And this was not easy, right? People were losing patience, which was natural, right? I mean, you have a sector in your portfolio that hasn't performed for 2.5 years. You would lose a little bit of patience. It was not. But COVID sort of accelerated the performance, right? As we had not expected this for about another year, right? We were expecting around, we were expecting performance around the fourth year or the fifth year, but COVID did accelerate our performance, and we slowly started cutting our position in tranches, right? And within about a year, we were fully out, right? By 2021. So your fund started performing in 2020, right? And we slowly, like how we slowly invested, we slowly exited, right? So in by mid 2021, we were fully out. Yeah, and just like this, we're building, we're basically bringing the same philosophy to Sphere NIO, right? Where we will continue to stick to high conviction ideas. We will continue to build large positions, right? And we will continue to do them efficiently, right? And we'll be efficient in our exits as well. So what can Sphere NIO do for you, right? We can help you create a versatile portfolio, which can help you get through tough market conditions and create wealth sustainably, right? And we can also help you to get through tough market conditions, as one of our areas of expertise is sectoral and thematic investing, where we are very efficient in sizing our position, right? And we know what the right time would be to scale a particular asset or asset class, right? And there are some things that we believe every investor can do. So let's take a look at that. Firstly, you must be patient with your investment choices. Rome wasn't built in a day, right? That's what they say. And things take time to grow, right? And secondly, buying the right asset class at the right time. Um, it's easy to say, but winners can become losers very quickly, right? So you keep valuations in mind. The market will throw a lot of opportunities over a given year. And as an investor, right, you owe it to yourself to participate in as many opportunities as you can, right? So this can be done through consistent contribution to the portfolio, right? So scale up, always scale up. It's good to save money in an asset, right? Anyways, and there are always a few ideas that the market is not looking at, that we can look at, we can evaluate, and if it merits it, we can invest, right? So yeah, participate in as many opportunities as possible. And finally, align your investments to a goal, right? This will give your portfolio structure, and it will help you invest with more discipline. You'll save and invest with more discipline if you know that you're working towards a number, right? And that paves a way for you to do things better. Yeah. So this is performance as of the end of July. So we're invested in equity, which is around 70%, right? We're holding about 15% in debt and cash. And yeah, we're holding about 12% in precious metals. And we have a little bit of global exposure, which is 3%. We've scaled up the global exposure to about 4% by now, and yeah, we will continue to look at more ideas, right? This may have changed a little bit, not by that much, but yeah, this is broadly where we are placed. Um, and if you look at the returns, right? So Sphere NIO was started on 17th October 2022. So whatever number you see here, this is all absolute returns, right? This is not CAGR, since it's less than 1, right? So if you look at Sphere NIO, and our benchmark is the multi-asset index, right? This has been our performance, as you can see. And yeah, when we started a multi-asset sort of investment philosophy, right? And when we were, looking through this idea, a lot of people came to us and they told us, "You've done pretty well in equity, right? Why do you want to move towards a multi-asset theme, right? Um, it won't be it won't give you as much returns as a pure equity investment." And so we were like, so our thought process was, we wanted to do something holistic, right? And we believe that if we do things right, if we structure the product right, um, this can do as well as any sort of equity product, right? And this is what Sphere and Sphere NIO have proved to do, right? And yeah, so we believe that investing in the right asset class at the right time, and being a little bit more patient and taking things more in a more structured way, it can really make a difference, right? So yeah, this has been Sphere NIO, and if anyone has any questions, I stop at the screen. If anyone has any questions, we can start with the Q&A. Okay, so we have one question. Sphere NIO, is Sphere NIO only for an NRI? And is it a new PMS? And I thought, how will this be different from the other PMSs? And return-wise, will this be consistent and superior from the other PMSs that I thought? Okay, so yes, sir. Sphere NIO is a new investment product. I mean, it came out last year, right, in October 22. So it's fairly new. Compared to our other funds, it's fairly new. So Sphere NIO is different in that, yes, it's targeted towards NRIs, and it's also a multi-asset fund, right? So all of our other funds, if you look at Solitaire, if you look at Vritti, right, you have equity investment strategies, right? Whereas this is a multi-asset investment strategy. So we'll have gold, we'll have silver, right? Those are your precious metals. We'll have international assets in terms of ETFs, right? So we can invest in foreign markets, right, through the ETF route, and also we have a little bit of fixed income, we have a little bit of equity, and all of this, right? There are no limits here. So if you look at most multi-asset mutual funds, you will have limits saying that fund X can go from 0 to 5 to 20% should always be there in debt, right? Or 10 to 15% should always be there in precious metals. We don't have any sort of restriction like that, right? So it's fairly flexible. We can have no allocation to debt if debt seems like if debt doesn't seem attractive, or we can have minimal exposure to equity if valuations go through the roof and we're not comfortable with anything in equity, right? Which is not likely, but we have the option, right? And for your other question, return wise, will this be consistent and superior? I mean, when it comes to returns, as we say, are a function of the market, right? I mean, our behavior is what we can control, and returns are something that is not in our control, right? So you might see phases of the market where this strategy might outperform the other strategies, but we tend to with the multi-asset modes, we're playing more for consistency and predictability than to get the highest return, right? But great returns have come from this strategy because inherently all of our investment portfolios follow the value investing philosophy, right? So inherently that scope to outperform the market is very much there, even if you go towards a more conservative investment strategy. But yeah, so for your returns question, I would say that they are a function of the market. It is possible in certain scenarios, but we're not, like that's not our goal, right? Our goal is not to get the greatest return of set X. Our goal is to more is more towards creating wealth sustainably, right? Creating wealth consistently, right? Not even sustainably. It's to create wealth in like a consistent and a sustainable way. What is the minimum investment? Okay, so by according to guidelines, it's a SEBI guidelines that our minimum investment be 50 lakh INR. So it's 50 lakh rupees, and yeah, over and above that, it can be scaled as like however. But the minimum investment to start a PMS should be 50 lakhs. That is according to regulations. Any other questions? How do we choose the goal cycle? That's a very good question. Um, so we mainly look at valuations, right? And we also look at what the central bank has been doing, right? So how are the overall broader rates? How strong is the bond market? And it's important to look at risks when you're looking at an asset like gold. Like, what are your overall macro risks? And what has been done to address that, and like how do I put this, what are the macro risks, what has been done, and what effect has that had, right? So for example, um, let me give you an example where something has been done, but it does not look like it's taken the effect as expected, right? If you look at the Fed, right, what the Fed's been doing right now, um, they've raised rates at a very, very fast rate, right? The pace at which they've taken action has been immense, right? It can be argued that they've been a little late to the party, and that's a debate for another discussion, which is probably true, right? They must have been late to the party. Um, but yeah, so the magnitude of rate hikes that they have taken, right? Um, but it still hasn't achieved their intended effect. Um, and yeah, and they've recently come out and said that, right? We might require a lot more action than we had expected, right, during the last 3 or 4 policy meetings. This again came out, and this increased the US bond yields again, right? So things like this, right? Macro factors, all of these play all of these play a role in how we choose to go about in gold, and of course gold's valuation also, right? We can't look at other factors, not look at what gold is doing for buying gold. But that being said, yeah, the valuation of the asset, the macroeconomic cycle, right? And if you're asking about equity, then it would be the sectors, and if we're picking a company, we have to dive deeper into the company. If we look at a theme, we'd have to dive deeper into the index and the companies in the index. But broadly, macroeconomic factors and valuations, right? They're they are common in any asset class. They are common. Any more questions? Thank you, sir. Okay, if there are no more questions, then I think we can close the webinar. So thank you everyone for joining us. Um, This is our contact details. So if you want to get in touch with us, please, you can do through, our social media. We have the phone number. We have the email ID. Yeah. So thank you for joining us on the Saturday. And I will see you in another webinar at another time. Yeah. Thank you so much.